So if you think the stock market is overvalued right now, perhaps even in a bubble that will eventually pop, you're not wrong. The Case Shiller P ratio, this is a valuation metric that divides the current price of the S&P 500 by the average of its 10-year inflation-adjusted earnings. And unfortunately, as of now, we are at the second highest valuation in history, only outdone by the levels it reached at the peak of the dot-com bust in 2000. Not a whole lot of people were investing 25 years ago, so you may not even be aware of just how bad things got when the bottom finally fell out. This is showing the three major stock indexes, S&P 500, NASDAQ, and Dow Jones, on an inflation-adjusted basis, and we can see that after the dot-com bust, it took the S&P 500 17 years to break above that 2000 all-time high. But this is why investing is so difficult and why so few people out there are actually good at it long term, because on the one hand, yes, the market may be setting up for an epic collapse. Valuations are near all-time highs. It would make sense to see a return at least to the long-term average. Nobody should be surprised in hindsight if things get ugly here. On the other hand, stocks may just keep going up for a few more years. What investors really need are strategies that can benefit if this bull market continues, but they can also be protected and maybe even make a nice profit if the next big market crash is right around the corner. That's where tactical rotation through volatility targeting comes in. I data mine all the volatility metrics and combine them into a single index that is the best representation of market volatility there is. I call this my VTS Volatility Barometer, and then I use it to strategically make sure that I'm only holding the asset classes that perform best given the current level of market volatility. You don't need to hold positions like gold or treasuries, for example, when the market is doing really well. There's no point in that. And likewise, you definitely don't want to be holding stocks or things like crypto when the bubble pops and the market crash happens. Our volatility barometer tells us what environment we are currently in, no guesswork. I sleep just fine at night because I know when volatility gets elevated and risk is rising, my strategies are going to shift out of aggressive positions and into safety positions. That's when we do use gold, and if things get really bad, we can use long volatility as well. Getting the signals and knowing when to buy that could change an investor's future.